This chapter is a practical, plain English tour of what security, financial, analysts do, and more importantly for you, what parts of their work a non-professional investor should understand and use. Graham's point is simple. Analysis is useful, but it has limits. Good analysis reduces surprises. Bad analysis, or blind faith in forecasts, gets you into trouble. The chapter explains the main tools analysts use for bonds and stocks, why analysts sometimes go overboard with fancy math, and how a sensible two-step approach can help a lay investor separate the valuable signal from the noise. Analysts examine a company's past results, its current financial position, and try to estimate future earning power. That work ranges from straightforward reading of financial statements to elaborate projections and industry studies. Analysts also judge safety for bond investors. How likely is the company to pay interest and principal? And attractiveness for stock investors. Is the company worth buying at today's price? Important caveat. The more an analyst's valuation depends on optimistic long-range forecasts, the less reliable it tends to be. Bond analysis is where security analysis is most rigorous and most dependable. The single clearest measure is coverage. How many times company earnings have covered interest and fixed charges over a multi-year period? Graham recommends looking at averages over several years, or alternatively, a poorest year test, rather than a single good year. Other helpful bond tests. Size of the enterprise. Very small issuers are riskier. Stock/equity cushion. How much junior capital exists to absorb trouble? Property/asset value. Important especially for utilities, real estate, or investment companies. History supports this approach. Many defaults and bankruptcies could have been avoided by applying strict coverage and capitalization tests. So if you're buying bonds, focus on demonstrated ability to pay interest and a conservative capital structure. Valuing stocks is trickier because value depends on expected future earnings. Graham describes the standard analyst's method. Start with past averages, forecast future sales and margins, then apply a capitalization (PE) factor. He warns that group or composite forecasts many companies together are usually more reliable than predictions for a single company. Mathematical sophistication doesn't make forecasts more accurate when they depend heavily on future assumptions. Analysts weigh several qualitative and quantitative factors when deciding the multiple to apply to expected earnings. 1. General long-term prospects, the industry and secular growth potential. 2. Management quality, track record, alignment with shareholders, honesty. 3. Financial strength and capital structure, cash generation, debt levels, leverage. 4. Dividend record. Long, uninterrupted dividends are a strong quality signal. 5. Current dividend rate, whether the payout policy makes sense for that company's life stage. Graham emphasizes that these are not mystical. They're rooted in assessing balance sheets, cash flows, and corporate behavior. For a quick, rough valuation of growth companies, Graham offers a simple guideline. Value equals current, normal, earnings times 8.5 plus 2 times expected annual growth rate. Growth is the expected annual rate over the next 7 to 10 years. Example, earnings of $2, expected growth of 5%, makes the multiplier 8.5 plus 2 times 5 equals 18.5, so value is approximately $37. Graham stresses it's only a rough tool. If you assume indefinite very high growth, the math becomes absurd. Values blow up, so always build in a margin of safety. Analysts study industries because a company's fate often depends on industry forces. Some industry research adds real value, technology, patents, R&D prospects, but much of it just repeats what the market already knows. The most useful industry work digs into concrete, hard-to-see facts, supply constraints, technological leads, regulatory shifts. Graham proposes, for clarity and discipline, that analysts should 1. Calculate a past performance value, what the stock would be worth if recent performance continued, mechanical formulaic. 2. Then judge whether future conditions justify modifying that value, senior analyst judgment. This separates mechanical, repeatable assessment from discretionary forecasting, creates accountability, and builds a recorded history of how forecasts fared. Key warnings: Don't idolize forecasts. Past results give more reliable guidance than long-shot projections. Be skeptical of high mathematical precision in valuations that rest on many assumptions. Management incentives matter. Look for executives whose pay and actions align with shareholders, not continual option repricings or opportunistic buybacks done to juice executive gains. Watch cash flow, not just accounting earnings. Modern investors should look at cash flow statements and owner earnings concepts, net income plus depreciation/amortization, normal capital expenditure, options and share dilution. Track the option overhang. Large potential future dilution lowers per share value. Buybacks timing matters. Good to buy back shares when stock is cheap, not at record highs. Managers who repurchase at peaks for short-term optics may be acting for themselves, not owners. Dividend history is a quality signal. Companies maintaining steady dividends over decades are demonstrably higher quality. If you're not a professional analyst, here's a compact action list taken from the chapter and the commentary. Read recent 10Ks and at least 5 years of annual reports. Check cash flow from operations and compute owner earnings if you can. Look at debt levels. Long-term debt under about 50% of capital is a sensible benchmark. Check interest coverage, earnings divided by interest, for bonds and debt safety. Review dividend history. Long, unbroken dividends are a plus. Watch insider activity. Form 4. Consistent insider buying is encouraging. Repeated big insider selling is a red flag. Ask whether growth expectations are realistic and whether current price already bakes them in. Prefer composite/group signals over single company crystal balling. Diversification helps because single forecasts are often wrong. Security analysis is indispensable, but it's a tool, not a crystal ball. Use the analyst's methods to examine safety for bonds and to build a disciplined valuation for stocks. Favor evidence rooted in the past and present, cash flows, coverage ratios, dividends, balance sheet strength. Treat forecasts and complex growth models as tools to inform judgment, not as prescriptions you must follow.